Stop celebrating your dividends. I know, it feels amazing to see free money hit your brokerage account while you sleep. But behind that passive income hype is a fundamental math error that millions of investors are building their entire retirement on. It's a mental framework that feels like a win, but acts like a handbrake on your wealth. If you're investing for dividends, you aren't winning. You're just falling for an accounting trick. Let's talk about why your dividend strategy is actually costing you a fortune.
My name is Luis, and I spend way too much time thinking about dividend investing, total returns, and why people make irrational decisions with their money. If you're someone who's been stacking dividend stocks in your portfolio, thinking that's the safest path to financial freedom, but something in the back of your mind keeps wondering whether you're actually doing this right, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, I'm going to walk you through exactly why the conventional wisdom around dividend stocks is wrong, what the math actually says, and what you should be doing instead. And I promise you, by the end of this video, you're going to look at your portfolio completely differently. So let's start with the thing nobody wants to hear. A dividend is not free money. I know, it feels like it is. But here's what most people don't realize. When a company pays you a dividend, the stock price drops by exactly the amount of the dividend on the ex-dividend date. This isn't some theory. This is mechanical. It's how markets work. So let's say you own a stock worth $100 a share, and it pays a $2 dividend. After that payment, your stock is worth $98. You have $2 in cash and $98 in stock. Your total? Still $100. You didn't gain anything. The company essentially took money out of its own value and handed it to you. It's like transferring $20 from your checking account to your savings account, and then celebrating because your savings account went up. That's the same money. You just moved it. Now, this is called the dividend irrelevance theory, and it was originally proposed by economists Merton Miller and Franco Modigliani, two Nobel Prize winners, by the way. Their argument was simple. In a rational market, dividend policy doesn't affect the total value to shareholders. The value of a company comes from its earnings and its growth, not from how it distributes cash. And yet, there's an entire investing subculture built around ignoring this. Okay, so here's where it gets really interesting. Let's talk about what the dividend obsession actually costs you in real dollars. Let's say investor A puts $10,000 into a dividend-focused ETF, something like SCHD, which is popular in the dividend community. And investor B puts $10,000 into a total market index fund, like VTI. Now, historically, the S&P 500 has returned roughly 10% annually over the long run. High dividend strategies? They've generally underperformed the broader market. Various analyses over the past 2 decades have shown that dividend-focused portfolios tend to lag total market returns by about 1 to 2 percentage points per year.
That might not sound like much, right? 1 or 2%?
But let's run the math over 30 years. $10,000 at 10% annually for 30 years gives you about $174,000. That same $10,000 at 8.5%, you end up with roughly $115,000. That's a difference of nearly $59,000 on a $10,000 investment. Scale that up. If you're investing $500 a month, which is realistic for a lot of people, at 10%, you're looking at about $986,000 after 30 years. At 8.5%, around $722,000. That's a $264,000 gap. $250,000. Gone. Not because of bad luck, not because of a market crash, but because you were optimizing for the wrong thing.
Now, you might be thinking, Luis, okay, but dividends feel different. I can see the cash. I can spend it or reinvest it. Growth stocks don't give me anything tangible. And look, I hear you. That feeling is real. But that's exactly the problem. It's a feeling, not a financial reality. Behavioral economists have a name for this. It's called mental accounting, and it was pioneered by Richard Thaler, another Nobel laureate. Mental accounting is our tendency to treat money differently, depending on where it comes from or what mental bucket we put it in. So dividend income feels like a bonus. It feels like income you earned separately from your investment. But it's not separate. It's your money coming back to you from your own asset. Here's an analogy. Imagine you own a house worth $500,000, and every year someone chips off a piece of your house, let's say a window, some siding, sells it, and hands you $15,000 in cash. Would you celebrate that? Would you call that passive income? Of course not. You'd say, hey, my house is deteriorating. But that's essentially what a dividend is. The company is distributing a portion of its own value to you and calling it income. And this psychological trick is incredibly powerful. A study from the National Bureau of Economic Research found that investors are significantly more likely to spend dividend income than capital gains of the same amount. People treat dividends like a paycheck, spendable, while treating portfolio growth as untouchable. Same dollars, wildly different behavior. And then there's the tax issue. Look, this one frustrates me because it's so straightforward, and yet it gets completely ignored in every dividend YouTube video you've ever seen. When you receive a qualified dividend in a taxable brokerage account, you owe taxes on it, even if you reinvest it. For most people, that's a 15% tax rate on qualified dividends. So if you receive $1,000 in dividends and reinvest all of it, you still owe $150 to the IRS. You're paying taxes on money you didn't even use. Meanwhile, an investor in a growth stock that doesn't pay dividends, they don't owe a single dollar in taxes until they sell. That means their entire investment compounds tax-free for as long as they hold it. Over 20 or 30 years, this tax drag is enormous. Various financial analyses have estimated that the tax drag on dividends can reduce your effective long-term returns by anywhere from 0.5% to over 1% per year, depending on your tax bracket and dividend yield. That compounds into real, serious money. And it's money you're losing for absolutely no reason.
Now, I want to be fair here, because I'm not saying dividends are evil. I'm not saying you should never own a dividend-paying stock. That would be ridiculous. Some of the best companies in the world, Apple, Microsoft, and Johnson & Johnson, pay dividends. And if you own a total market index fund, you're already receiving dividends from hundreds of companies. The problem isn't dividends themselves. The problem is when you make dividends the primary criterion for building your portfolio. When you're picking stocks based on yield instead of total return. When you're avoiding high-growth companies because they don't cut you a quarterly check, that's when you start leaving serious money on the table. Here's where dividends do make sense. If you're retired and you need actual cash flow from your portfolio without selling shares, dividends can be one component of that income strategy. If you're in a tax-advantaged account, like a Roth IRA, where the tax drag is irrelevant, dividend stocks become less problematic. And if a company you already love happens to pay a reasonable dividend as part of a broader shareholder return strategy that includes buybacks and reinvestment, that's perfectly fine. The key distinction is this: let dividends be a byproduct of good investing, not the goal of your investing. So here's what I'd actually recommend if you want to build real, lasting wealth. And these are actionable steps, not vague advice. First, focus on total return. Total return means dividends plus capital appreciation. When you evaluate an investment, look at what it returns in total, not just what it pays out. A stock that grows 12% and pays no dividend is objectively better than a stock that grows 4% and pays a 3% dividend. The total return is what determines your wealth.
Second, prioritize broad diversification. Instead of hand-picking 20 or 30 dividend stocks, which concentrates your risk in specific sectors like utilities, energy, and financials, own the entire market. A simple 3-fund portfolio with a total U.S. stock market fund, an international fund, and a bond allocation gives you exposure to thousands of companies across every sector. It's boring, and that's exactly why it works. Third, maximize your tax-advantaged accounts before investing in taxable ones. Every dollar in dividends you receive inside a Roth IRA is tax-free forever. That eliminates the entire tax drag problem. So if you are going to own dividend-heavy investments, at least put them where Uncle Sam can't touch them. And fourth, and this is the big one, stop checking your dividends. Seriously, uninstall the Dividend Tracker app. Stop posting screenshots. That dopamine hit you get from watching $4.37 hit your account is actively distorting your decision-making. It's making you optimize for a feeling instead of for your financial future.
Here's the thing. I know this video might be uncomfortable for some of you. If you've spent the last 2 or 3 years building a dividend portfolio, nobody wants to hear that their strategy might be suboptimal. But I'd rather you hear it now, when you still have time to adjust, than 20 years from now, when you're looking at a retirement that could have been $250,000 larger.
The financial media and social media have turned dividend investing into an identity. It's not just a strategy anymore. It's a community, it's a lifestyle, it's an entire aesthetic. And that makes it really hard to question, because questioning the strategy feels like questioning your identity. But your portfolio doesn't care about your identity. It cares about math. And the math is clear. Focus on total return. Diversify broadly. Minimize taxes. And invest based on evidence, not emotion. If this video made you rethink even one thing about your portfolio, hit that subscribe button and leave a comment telling me what clicked for you. I read every single one. And if you want to go deeper on building a portfolio that actually maximizes your long-term wealth, I'll see you in the next one.